Coming to terms with no stimulus anytime soon, with a possible all-blue government, and with a virus that just won't go away. Welcome to Bloomberg Wall Street Week. I'm David Weston. This week, Senator Ben Cardin of Maryland, contributors Larry Summers of Harvard.
Doing without stimulus at a moment like this is kind of like wading into a crowd not wearing a mask.
Afsani Beschloss of the Rock Creek Group, and Bloomberg's Stephanie Flanders.
The idea that this is going to be really a much easier thing the second time around is, I think, wishful thinking.
Joe Grunfest of Stanford.
People in many ways are reaching for yield and looking for opportunities, and SPACs are a very interesting opportunity.
And Bob Diamond of Atlas Merchant Capital. This week, we may have finally put to rest the idea of getting more fiscal stimulus before the election. As Majority Leader McConnell said he wanted to go small, President Trump said he wanted to go big.
We are trying to help, and we're trying to get some stimulus money, which I think is very important for certain industries, certainly the airline business. You know, people aren't exactly hopping into airplanes to travel.
And Speaker of the House Pelosi said that even the president's big wasn't big enough. The major U.S. banks waded into the middle of the confusion with third quarter earnings that generally were a pleasant surprise because of trading and lending that was a bit better simply because the banks didn't have to reserve as much for people who couldn't pay what they owed.
You are also seeing a disconnect between large corporations and small businesses and consumers, which are struggling.
But the prospects going forward were clouded by, you guessed it, the uncertain pace of recovery because of the lack of stimulus. The markets struggled to figure it all out on top of an election just over 2 weeks away that looks like it might go blue, and maybe first and foremost, a coronavirus coming back strong on both sides of the Atlantic. But fortunately, we have just the right people here to help the markets understand this difficult week. Bob Diamond is CEO and founding partner of Atlas Merchant Capital, and Wall Street Week contributor Afsani Beschloss is CEO and founder of the Rock Creek Group. So Afsani, let me start with you. As I said, really, we had a lot of uncertainty this week about the stimulus, about the COVID coming back on both sides of the Atlantic, and about the economy overall. Why does the market, the equity market, keep going up? This is 3 weeks in a row now.
You know, David, it's interesting because just in the last few days, the equity market rate of growth has kind of slowed down. I think the markets are watching the stimulus plan, as you said, the uncertainties that have increased. The other side of it, though, is I think there is more and more agreement in the market that it is possible that Vice President Biden may be getting elected. And people are starting to digest the fact that taxes may come later, but fiscal policy could come earlier, and that could result in serious growth. And if there is also more equitable kinds of packages that the government does put out compared to right now when we have no agreement on a stimulus plan, that could also be very helpful for growth. So markets are starting to take some of those theories into consideration as they have gone up a little bit this week and last week.
So, Bob, what do you think about it? I mean, is it sort of a hope that there's an all blue, if I can call it that, government? Or what are the markets paying attention to? What should they be paying attention to?
Well, one of the things we see in the equity markets is, you know, they call it the Dow because it's a certain number of companies that they're following, and the S&P 500. And a lot of the small businesses, I mean, David, the truth is that 400,000 small businesses have closed since the pandemic. I don't think any of them would be publicly listed or in any of those indices. So in the economy, what we're seeing is we're clearly in the third stage. I mean, the first stage was closing the economy, and it was kind of the left side of the V. Now, the right side of the V was equally sharp coming back up, but it stopped well below the level at which the economy had been. And it's really a question now of, is it going to be even there? Is it going to continue to go up, or is it going to potentially go down? And that's why there's so much focus right now on the need for more stimulus.
Well, at the same time, Bob, what do you make of things like the retail sales numbers came in at the end of the week, and they were actually surprisingly strong, and also housing seems to be doing well. There are some indications, aren't there, that the economy actually is doing pretty well?
Yeah, you know, consumer spending is really, really strong, and so people look at that. But if you tear that apart, spending on goods is up strongly. Since February, since before the pandemic, consumer spending on goods is up actually 5%. It's higher than it was in February, where services are about 60% of the level that they were pre-pandemic. Now, here's the rub. 2/3 of the economy is in services, and 85% of the employment in our economy is in services. So when we look at those consumer spending numbers, we have to separate what's on goods versus what's on services, and the real impact on small businesses and employment in the services sector. I mean, we kind of all know it, but the numbers are very stark.
So, Sonny, Bob Swing makes a very good point about this divergence between services and goods, which I think is different from what we've seen before, isn't it?
Absolutely. I think Bob is absolutely right. And this is something which is a global phenomenon, by the way. Obviously, services sector in this country has increased its share hugely. But even if you look at parts of Europe and in particular in Asia, the share of services have also increased on a relative basis. But that certainly is a really important factor. I would say also when we look at these numbers, they hide so much, as Bob said about retail. We look at the unemployment numbers, they're hiding the fact that the total number of people who actually are staying unemployed is getting larger and larger. The number of people who are unemployed in the lower income brackets is going up, while in the higher brackets, it's not going up as much. So that disparity that we're seeing overall in the economy is happening also inside those employment numbers.
Sonny, one of the things that struck me this week was we had the IMF meetings. And we heard earlier from both Federal Reserve Governor Jay Powell and also Madame Lagarde from the European Central Bank that we need more fiscal service. But we actually heard from the IMF. We heard Kristalina Georgieva today say, don't worry about the deficit. I don't remember the last time I heard the IMF say, don't worry about a fiscal deficit.
I was going to say, Bob Diamond and I have gone to many World Bank meetings, and I worked at the World Bank, so I ran a lot of those meetings. And it was really interesting because it's always been about fiscal austerity, right?
Exactly.
And this is a huge change in direction that the head of the IMF has declared. And also, by the way, a lot of economists are talking about. But what I would like to also highlight is that who can borrow, actually. She has said we should, those who can borrow should borrow and get their economies to be on a different growth path. And I actually quite agree with that. The problem is those countries that cannot borrow. Obviously, the IMF has some money to give out to those. But if you think about the scale of the countries that are in need and cannot borrow, that is huge.
Bob, what about that? What about the companies that can't borrow? Because one of the things that Kristalina Georgieva talked about was some debt relief.
Yes. And by the way,
for Bob.
Oh, sorry.
Yeah, no, I mean, there's no question. I think I saw an interview with Larry Fink, who talked about being bearish on the emerging economies today. I think when you look at the reaction of the currencies and the unemployment levels, it's a function of how difficult it is for them to get the fiscal stimulus, 100%.
At the same time, Sonny, is this an alarm bell for us that the IMF itself is asking for more lending? That suggests something about the global economy that's not very strong.
Well, I think the IMF has realized that having these very, very strict austerity programs when countries were down actually did more damage. So they have learned the lesson, which is a good thing. I think the question is that if you borrow, eventually you have to pay it back. And these countries, if they borrow in US dollars and their own currencies depreciate relative to the US dollars, will have to even pay larger amounts. And so they are going to be in more trouble down the line, unless they get on a growth path that gets them out, which is sort of the way the IMF is talking right now. And the chief economist of the IMF is also talking that way.
Bob, just to pull this all together, let's go back to Sonny's original point. Should we be encouraged by the fact that it may well be, not certain, may be that we get a President Biden, maybe even a Democratic Senate, and they certainly will borrow, and they will spend a lot of money?
I think business is a lot more comfortable with the prospect of a Biden presidency. Now, it'll be an increase in corporate taxes. He said that. But remember, corporate taxes went from 35% to 21%, and Vice President Biden's talking about 28%. There'll clearly be an increase in capital gains tax. But on the other hand, we can expect more stimulus in a Biden administration than I think we would otherwise. And I'm going to tell you, I think trade relations around the world, which have been truculent, to steal a phrase from another one of your guests today, Larry Summers, and I think that will change. And I think the prospects for a boost to the economy with better relations and better trade, there's some positives here.
Many thanks to contributors Alcina Beschloss of Rock Creek Group. Bob Diamond of Atlas Merchant Capital will be staying with us because we want to talk about those bank earnings that came out this week. This is next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The big U.S. banks reported their third quarter results this week, and it was something of a mixed picture. Trading was way up, at least for the most part, and net interest income was down, as were provisions for the loan losses. To take us through what we learned about the banks, Bob Diamond of Atlas Merchant Capital is still with us. Bob, of course, served as CEO of Barclays. So, Bob, what did you make of this picture of the banks?
Well, it was a better third quarter than second quarter. And the second quarter, David, is as you and I both know, net income for the banking industry was down about 70% year on year. But I think the message here was we saw really a clarity to the difference between the more you were in commercial banking and taking deposits and making loans, and the more you had a more balanced business in asset management and wealth management, and particularly in the trading businesses, the Goldman Sachs and the Morgan Stanley, probably the extreme example, the better the results.
So what do you do if you're a Bank of America? Because they tend to be more in the traditional commercial banking sector. Do you try to make it up on volume and cut costs? What's the strategy?
Well, they certainly have a good sales and trading area as a result of the Bank of America acquisition during the financial crisis. So it's probably a question of balance, is that they're so big and so large in commercial banking that it probably overshadowed that a bit. I think the challenge for the commercial banks is just what we were talking about earlier. 400,000 small businesses have already closed this year. The services sector, which is 85% of the employment in our economy, is really, really suffering right now. So are the loan loss reserves, which are up significantly, and for the four biggest banks, loan loss provisions are about double in the first half. And the question is, are they enough and are they adequate? I would suggest that the risks are on the downside there.
Well, that was part of my question. If you're a commercial bank right now, are you more worried about bad loans, or are you worried about just lack of demand for further loans?
Well, I think you're worried about a couple of things. You're worried about, taking in deposits, and the 4 or 5 largest banks have 60% of the deposits in the U.S., but at zero interest rates. How are you earning money on those? So where is the earning coming from in a zero interest rate environment? Where the Fed is saying that we're going to have zero interest rates or something similar to that out 2, 3, or 4 years. And on the other hand, you have, real significant issues around certain sectors of the economy and certain businesses in terms of the potential for them to be loan loss provisions or increased loan loss, or in fact, real losses. So I think it's very, very challenging for the traditional large national commercial banks to see where their earnings are coming from. And I think further, there's a bit of worry in terms of loan loss provisions.
So, Bob, if you're an investor and you want to invest in banks, where do you go? Do you go to the big banks that we tend to think about so often? Do you go to regional banks and local banks? Do you go to something that's really not quite a bank traditionally, but is in the banking sector, or at least doing things that look like banks?
Well, that's the interesting thing, David. We are investors in financial services, and we have 3 broker-dealers in our portfolio, one in the U.S., one London-based, and one Paris-based. It's a European equity platform. All 3 are having record performance this year and continue very strong into the third quarter. So there are platforms such as the broker-dealer platform that can be more efficient outside of a bank holding company than they can inside of a bank holding company. As we've seen with the large national banks, we talked about too big to fail in 2008. Well, the largest national banks are bigger. They're probably more systemic. They're definitely more connected and intertwined with the government. There's more correlation of risk to the national economy. And for all of those reasons, whether you're being driven by technology or other business models, kind of the monoline approach to focus on certain business sectors and become a specialist in those business sectors, whether it's a broker-dealer or a payments processing business, there's a lot of opportunity outside of the large bank holding company.
And briefly here, Bob, we're so close to the election, we can't get by without asking, what would a Biden administration, if it happened, mean for the banks? We heard Jamie Dimon this week say, actually, he's hopeful if Biden got elected.
So I don't know if it's specifically for the banks, but I think what we're seeing is businesses getting more and more comfortable with the prospect of a Biden administration. And I think the impact that he can have in terms of trade relations and relations with other countries around the world, the impact he can have in terms of the stimulus program because of all the things we're talking about earlier in the program with the services sector. And, for me, what do I worry about every single day? Unemployment and small businesses. And how has the pandemic had an impact on them versus large technology companies? We know they're doing fine, right? But small businesses, particularly small businesses in the service sector, and to say, the number is stunning. It's 85% of the employment.
Yep. Ultimately, the banks are healthy only if the underlying economy is healthy, I think it's fair to say. Many thanks now to Bob Dimon of Atlas Merchant Capital. Always great to have him here on any subject, but particularly when it comes to banking, which he knows so terribly well. Coming up, the usually irresistible force of central bankers comes up against the immovable object of fiscal authorities. Wall Street Week contributor Stephanie Flanders is here on why it's so difficult to do what the economists say is so necessary.
The impact on the economy could be quite profound, so you can't turn off the support yet.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Last week, it was Fed Chair Jay Powell and ECB President Madame Lagarde. This week, it was IMF Managing Director Kristalina Georgieva at her annual meeting, who laid out in no uncertain terms that the global economy needs help and that it needs to come from the fiscal side. Wall Street Week contributor and senior executive editor of Bloomberg Economics, Stephanie Flanders, gives us the over and under on getting this fiscal help we need on both sides of the Atlantic.
Well, I guess we should pause to reflect on the fact that the International Monetary Fund has not historically been a great source of fiscal stimulus and a booster for fiscal stimulus. You remember even just in the last global financial crisis, after supporting fiscal action to help economies for the first year or two, they were among those who said we should, was in favor of austerity in the Eurozone and elsewhere. So to have the head of the IMF saying, if anything, the danger is too little rather than too much, even as she unveiled a significant rise in debt stocks and borrowing across the world, was quite a thing to behold. But of course, it's facing. She's reflecting the reality, which is that economies are not out of the danger zone. And in fact, if you're sitting in Europe, you feel like you're going back into a very risky period with, curfews being introduced across France, tighter restrictions across large parts of the UK. The impact on the economy could be quite profound. So you can't turn off the support yet.
So we all are very concerned about the uptick, the surge, if I can put it that way, in the number of cases of COVID-19, certainly in Europe and here in the United States, much of the United States as well. At the same time, the lethality of it seems to have gone down. Not as many people are hospitalized or dying, are they?
Well, it's interesting because that was what was happening in the summer. And I think there was a certain amount of complacency even about the rising rates towards the end of the summer because they didn't seem to be accompanied by hospitalization rates. And it's certainly true that in the US particularly, we've got much better at treating. We've seen a very high profile case recently, but we've got much better at treating coronavirus. Actually, across Europe, you are starting to see older people start to get COVID again, and that is starting to fill up hospitals again. So the idea that this is going to be really a much easier thing the second time around is, I think, wishful thinking, although we certainly have a better handle on how to treat it.
All the economists seem to agree we need to continue, even increase the fiscal stimulus. At the same time, are we putting off the time when there have to be other readjustments made in the economy for the long-term health of the economy? And I'm not talking about cutting back on fiscal stimulus. I'm talking about repurposing people and industries. I mean, you have a wonderful podcast called Stephanomics in which you talk about the jobs. Are we supporting jobs that maybe will go away?
Yeah, if I'm allowed to boost for a moment on the Stephanomics podcast, actually this week we had a wonderful piece from Spain, from Cadiz, the southwest of Spain, addressing exactly that point. Which jobs are gone forever and which actually could come back? And there's a shipbuilding industry there that clearly has not come back, and is workers from there have then gone on to, for example, working in airline engineering, now they're engineering for aircraft, for Airbus. Now they're facing the possibility of long-term redundancy and asking themselves, is the airline business going to go the way of shipbuilding? And the honest answer is, for a lot of the economy, we don't know. Even the changes that we think are going to be permanent, people wanting to work from home or people traveling for work less. In a few years' time, will we be laughing at those predictions that the world was going to change? What governments shouldn't be doing now is forcing businesses to prejudge what their future business model is going to be. And that probably means giving more support, even if some of it ends up being for jobs that aren't going to last.
That was Bloomberg's senior executive editor for economics, Stephanie Flanders. Now it's time for a Global Markets Week in Review.
Asia's third quarter reporting season is underway, and we got some upbeat forecasts from big players like Uniqlo operator Fast Retailing and iPhone chip maker TSMC. But Asian stock gains started fizzling out midweek, with U.S. election uncertainty casting a shadow. And looking ahead to next week, China's third quarter GDP report is expected to show faster growth, and while the PBOC is likely to hold on the loan prime rate, it may guide the LPR lower to guard against downside risks. And ahead of that, the yuan lost ground this week after the PBOC moved to curb the pace of gains by making it cheaper to short the currency. Danny?
Thanks, Sophie. The big story in Europe this week, big decisions when it comes to Brexit, with the UK's self-imposed deadline coming and going, and record coronavirus case counts in Italy, France, Germany, and Ireland. That brought more restrictions that not only had more political opposition this time around, but also sent stocks lower in the middle of the week. Ahead for next week, we look forward to big bank earnings like UBS here in Europe, as well as big consumer brands like Unilever. Scarlett?
There was a lot of investor focus on the race for a COVID treatment. Eli Lilly and Johnson & Johnson said they had to pause their clinical trials because patients got sick, while Pfizer clarified that it is seeking a late November timeline to seek FDA approval for its vaccine. Meantime, the third quarter earnings season ramps up, and in the coming week, we'll be hearing from big tech, legacy names including IBM and the mega caps such as Microsoft, companies that give us a more direct read on the state of the consumer like Procter & Gamble, and a couple of energy names. The backdrop is we are still in the middle of an earnings recession, although things should improve from the second quarter. And by 2021, the comparisons get a lot easier, and analysts expect a return to profit growth.
Coming up, internet companies, cryptocurrencies, pot stocks. Are SPACs the latest financial fad? We talk the ins and outs of SPACs with former SEC Commissioner Joe Grunfest of Stanford.
We are at a point where we've got more supply of SPACs than we do of companies that really would rationally merge into them.
This is Wall Street Week on Bloomberg. Cryptocurrencies and cannabis stocks were once all the rage. Now it's SPACs, also known as Special Purpose Acquisition or Blank Check Companies. A SPAC raises money from investors in a public offering for a war chest it uses to go shopping for an attractive private company. If it finds a good prospect and can strike a deal, then it merges with the private company and, presto changeo, the private company is now public.
There have been a number of very, very successful SPAC deals. And I think there are advantages, structural advantages, SPACs over the IPO, which is, as we talked about, a shorter process, more bespoke transactions.
For companies hoping to go public, SPACs are an attractive option. They do away with all those messy issues like paying underwriters and undergoing regulatory scrutiny that come with an IPO or a direct listing. blank check companies have already raised a record $41 billion this year, led by Bill Ackman's record SPAC, which all by itself raised $4 billion this past summer.
So we've designed the most friction-free structure in which to go public, and that we think is going to give us an opportunity to buy great business.
SPACs are not risk-free. Of the 313 SPAC offerings since 2015, only 93 have taken a company public, according to Renaissance Capital, and not all of the deals were home runs. Only 29 of those SPACs produced positive returns through September. SPACs have attracted interest mostly from institutional investors and hedge funds. Retail investors who want a piece of the action can buy into the Defiance Next Gen SPAC-derived ETF, ticker SPAK, which debuted this month.
We find so many great companies that are going to be those enduring leaders tomorrow, that will be the Amazons and Microsofts and Googles of tomorrow.
The SPAC trend has some big-name backers, including not only Bill Ackman, but also former House Speaker Paul Ryan, NBA Hall of Famer Shaquille O'Neal, and now SoftBank's Vision Fund. SPACs are even changing the face of baseball. Billy Beane of Moneyball fame became an essential part of the Oakland A's front office. And in 2005, he declined an offer to become general manager of the Boston Red Sox. He stayed with the A's, but now he has a SPAC which, ironically, is on the cusp of buying the parent company of none other than the Boston Red Sox. So it may be a SPAC that takes Billy Beane out of the Oakland franchise and puts him into a Red Sox uniform, at least financially. SPACs may sound too good to be true. All of the money and none of the regulatory oversight. So we asked former SEC Commissioner Joe Grunfest of Stanford what the trade-offs really are.
There's several factors that are simultaneously coming together in the market. First, there's an appetite for risk. I don't think there's any doubt about it. When interest rates in the United States are close to zero, and when the Fed has signaled that they're likely to remain close to zero for a long period of time, and you've got very significant amounts of bonds trading at negative interest rates internationally, people in many ways are reaching for yield. They're looking for opportunities. They're looking for more attractive ways to put their money to work. And SPACs are a very interesting opportunity. At one level, they're an arbitrage opportunity for people trying to make a little bit of money on the side. If you can pick up 1%, 2%, 3% relatively risk-free in today's environment, that's a very nice trade for some people that play in the SPAC market. And then it's another way to get exposure to some early stage IPO-style returns with a much more significant degree of risk for other investors at a different stage in the SPAC life cycle.
But do we lose something in the regulatory oversight, or do you think it's just as good as an IPO or a direct listing, which are also getting quite popular right now?
I don't know that I'd use the phrase just as good. Instead, what I'd say, there are multiple differentiated ways of companies coming to the market now. As you properly pointed out, we've got the traditional firm commitment underwriting. We now have direct offerings. Those are, however, primarily done as secondaries. We don't yet have situations where companies themselves are doing direct offerings and coming to the market. And then we have these SPAC transactions, where, again, you're absolutely right. When you initially buy into the SPAC, you have no idea who the merger partner is going to be. You're instead betting on the founders of the SPAC and their ability to find a good merger partner, and more importantly, or just as importantly, negotiate a price that will be appealing to the investors.
For the reasons you described, this is very popular right now. A lot of people are doing it. It's almost an unlimited number of SPACs. At the same time, the track record, thus far at least, is not all that strong. I mean, if this were really, truly a better mousetrap in the longer term, then you'd think the value of these things would be going up. It's not consistently going up as they go public.
That's a hard measure, right? Because there's a lot of risk in many of these SPACs, and in situations where there's a lot of risk, what you expect to see is a lot of volatility. That's the definition of risk, and that's precisely what we're seeing. We're seeing some SPACs run up. We're seeing some SPACs not do as well. We're seeing situations where SPACs go public and there are questions about the integrity of the SPAC and the due diligence process that led to the transaction. But by the same token, you've got the same kind of issues in many traditional IPOs as well.
Who's making the most money off of these? Are they the people who put together the SPACs? How do they get paid, compensated?
Again, it's all over the map. There have been a number of situations where some early funders of SPACs, where the promoters of SPACs, have made a large amount of money by putting up a relatively small amount of money. Here in Silicon Valley, that's been pretty remarkable, because if you stop and if you think about Silicon Valley, you know, if you fund a company in Series A, and if the plan is to take it public, you're typically in today's world talking about a 10 to 12-year life cycle. So you have to be a patient investor. It's not quick money out here in Silicon Valley. It's patient money, it's hard work, it's a lot of risk. Now, if you sponsor a SPAC, and if you wind up doing a good deal, you can make, you know, 100x on the amount of money that you put in, and you walk away with it in less than 2 years. So, and that, by the way, is one of the reasons why we see so many SPACs coming to market. There's an option-like structure here, and what you've got is a lot of, you know, well-capitalized, high net worth individuals who say, look, I'm going to buy the equivalent of a call option. If it works, great. If it doesn't work, all right, what have I lost? A few million bucks.
Thus far, it's been very sophisticated investors, institutional investors and hedge funds that have principally been investing in these. But now we have an ETF. What happens when the retail investor can participate in this? Is that a good thing?
Well, you know, I think the phenomenon's a little bit different. It's not that it's moving to the retail investor, it's the demand-supply equilibrium. You have a look at the number of SPACs that exist, then you have a look at the number of companies that are really at a point in their growth cycle where it makes sense to go public through a SPAC. And I think we are at a point where we've got more supply of SPACs than we do of companies that really would rationally merge into them, which in a sense, you know, given the leverage that's available to the promoters, is something that I would entirely expect in this environment.
That was Joe Grunfest of Stanford. Coming up, whatever happened to that stimulus we were promised? And will we miss it? Senator Ben Cardin of Maryland says we do and we will.
I would have thought that by now we would have passed the next round of COVID relief.
This is Wall Street Week on Bloomberg.
The stimulus package that the Congress was considering at the end of the year, we thought was not structured particularly well. The people who are hurting in this economy are middle income and lower income people. This is where the unemployment has been concentrated. And we think that a stimulus package, to be effective on the fiscal policy side, really has to target those individuals and those households.
That was Abby Joseph Cohen of Goldman Sachs on Wall Street Week way back in 2002. But the story really isn't all that different today. People are hurting once again, and once again, the biggest hurt is in the middle and lower income groups. We asked Democratic Senator from Maryland Ben Cardin whether we truly need more fiscal stimulus this time.
We desperately need it. There's no question. We've needed it for months. When we passed the CARES Act in March, we anticipated that COVID-19 would be over by now and our economy would be back on track. That's certainly not the case. We needed a bill passed. The House did their work in mid-May. They have repeated that action more recently with a version that's closer to what the numbers that the president wanted. We should have had a second round of COVID relief well before now. It's desperately needed for small businesses. It's needed for state and local government. It's needed for our schools. It's needed for homeowners and renters. We've got to get it done. It should have been done long before now. And it's clear to me that the president's not interested in this other than the politics on his election. And the Republicans in the Senate, Mitch McConnell, won't bring up a bill that would do the work.
Well, let me ask you that question, because the president yesterday tweeted that, in fact, we should go big or go home when it comes to stimulus. He's sent some messages, conflicting messages, but he's sent some messages. He wants to have a big stimulus bill. If the president were to go forward and Secretary Mnuchin worked something out with Speaker of the House Pelosi, do you believe it could be gotten through the Senate with some of the Republican senators and the Democratic senators joining some of the Republicans?
Yes, I think it could, but Mitch McConnell won't let that happen. Let's be clear. Mitch McConnell is not going to bring a bill to the floor of the Senate that would pass by Democratic votes without a majority of Republicans voting for it. And he doesn't have the majority of his caucus in regards to what the president is saying. So yes, I think the votes are there, but look at hundreds of bills that could have been enacted by now that Mitch McConnell has not brought to the floor of the United States Senate. So I think it's highly unlikely that that scenario will take place.
One of the things, Senator Cardin, you know well that Speaker of the House Pelosi has been saying we need this bill in part to fight the COVID virus itself. You have an interesting position that you've taken, as I understand, with your colleague, Marco Rubio, saying, you know, it's not just U.S. we should be worried about. We should also be worried about fighting this virus around the world because it is global. We can't stop it at our borders.
Exactly. The COVID relief package needs to deal with the international aspects as well as domestic aspects. We still have not done our work at home, and we got to take care of our needs here in America. And we need to lead by example. And our example is not one in which the world is saying we want to follow. But then we also have to recognize that this is a global pandemic. And until it's controlled globally, we're still at risk here in America. So yes, we have made it clear that we need to include international aspects to our response to this pandemic.
Senator Cardin, if it's not to be done, this fiscal stimulus before the election, let's talk about after the election. Do you anticipate perhaps there would be a significant stimulus bill, whether it's a President Biden or a President Trump coming in the lame duck session?
You know, it's difficult to make a prediction. I would have thought that by now we would have passed the next round of COVID relief. It's desperately needed. So yes, after the elections, I am optimistic. If we don't get it done before the elections, that we would recognize that relief is needed. State and local governments desperately need help. Our school systems desperately need help. Small businesses desperately need help. The airline industry needs help. And the list goes on and on and on. The sooner we get it done, the better. If it's not before the elections, I would hope, regardless of the outcome in the election, we would get it done in a lame duck session.
That was Ben Cardin, Senator from Maryland. Coming up, we wrap up the week, as always, with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Every week about this time, we turn to our special contributor, Larry Summers of Harvard, to wrap up the week and help us look forward to the next week. So, Larry, a lot happened this week, but let's start with one thing in particular. We had the managing director of the IMF, Kristalina Georgieva, come out and say, we really need a lot of fiscal stimulus and don't worry about borrowing for it. That's not surprising because we've heard other central bankers say that, but it's kind of surprising coming out of the IMF, which typically is associated with fiscal prudence. So what does that tell us about the state of the global economy?
I think the managing director's to be complimented for what she said. I think it may be remembered as a very important moment. In the late 70s, around the time Paul Volcker became chairman of the U.S. Fed, there was a seismic change in macroeconomic policy thinking towards the idea of inflation as a central problem, independent central banks as crucial institutions. I think in the same way that that was a revolution, we are now entering into another period of revolution, this time around concerns about remarkably deflationary pressures, concerns not about excess demand, but about insufficient demand, focused not on monetary policy, but on fiscal policy. And I think in a very important way, we are all headed back to the future through a resurrection of Keynesian economics. And that you had the very center of the orthodoxy establishment, the International Monetary Fund, calling for it, is telling you something very profound. It's not only the IMF, it's Jay Powell insisting on the importance of fiscal stimulus, larger budget deficits. It's Janet Yellen publicly embracing the concept of secular stagnation. It's Christine Lagarde cheering on the process of fiscal stimulus. It's Mr. Kuroda in Japan talking about fiscal monetary cooperation. Many people don't realize it, but the paradigm of the last generation is over. And it's a new paradigm where the focus is going to be on assuring adequate demand, assuring adequate fairness in our economies. We don't fully know yet all the forms that paradigm is going to take. We're going to have to think about the associated risks, and there will be risks, just as there was terrible recessions as we transited towards low inflation. But we are headed into a very new paradigm, and people who want to understand and profit from markets are going to have to factor chronic low interest rates, chronic shortfalls of demand, much greater reliance on fiscal policy, past peak central bank independence into their thinking if they want to understand how the world is going to move. Some of this is a COVID thing, but much of it is entrained before COVID and will be there long after there's some kind of COVID vaccine.
Well, and in fairness, Larry, to you, and to give credit where it is due, you were warning about this before COVID ever showed up, before we ever knew that word. You were talking about this. But in listening to Madam Georgieva this week, it wasn't just the need for fiscal stimulus she was talking about. She also was talking about debt relief for the third world. You came out with a statement with the G30, some of your colleagues, where you really warned about what's happening with some of the poorest countries around the world.
That's right, and I think that's the other big development of the week. People are realizing that the fact that no shoe has fallen yet in the developing world doesn't mean that they're not a set of shoes that are going to fall. Look, the really disturbing thing, and much of the blame sits with the United States and its president and its Treasury Secretary, is that while the world's had a vast domestic response to COVID, trillions of dollars in deficits, an increase in central bank balance sheets and all that, much larger than it had after the great financial crisis in 2009. At the international level, it's been a squirt gun. It's been a tiny little debt relief initiative extended for 6 months, with no bold plan for providing foreign assistance to help meet the health needs, no compensation for the lost remittances as people can't travel across countries anymore, no plan to deal with the 10% reduction in export volumes. The world sat on its hands 6 months ago at the spring meetings. The world sat on its hands these last 6 months, and on current form, it's going to sit on its hands at the G20 in Saudi Arabia. And maybe we will get away with it. Maybe everything will be okay and a recovery will come. But prudent policymakers hope for the best and plan for the worst. And we don't even have a plan for the best guess. We have a prayer for the best, and we call it a plan. As I said last week on this show, it's a lot like wandering around in a crowd without a mask during a COVID epidemic. And that is the moral equivalent of the approach the world took to standing behind the world's poorest people this week. There are 100 million more people in poverty, and we averted our gaze. There are millions more people hungry, and we did nothing. A generation of children are at risk of being lost from schooling and the possibility of career paths because of the neglect of global policymakers.
We always like to end the program with Summer Says, a very special segment here. And let's do a lightning round right now. And we're going to change it a lot this week, and we're going to say basically we're going to surprise the upside or surprise the downside on certain topics. What about COVID? Is it going to surprise the upside or surprise the downside?
Probably upside in the next 2 or 3 months. The next year, it may surprise on the downside, but next 3 months, surprise on the upside.
Which means we'll have more of it than we expect rather than less.
That's right.
Okay, what about inflation? Because there's some people who are thinking inflation's coming back, particularly if we have a President Biden.
For the next year or so, it's not going anywhere. Who knows beyond that? My guess is it's down for a good long time.
Do we have the capability of resisting the secular stagnation you've warned about? Is it a matter of political will or ability?
First, it's a matter of intellectual comprehension, and most of the financial community and much of the policy community hasn't gotten there yet. When we recognize that there's a problem of a surfeit of savings relative to investment, this is a problem that can easily be solved. It can be solved by doing fantastic things, extending broadband to all, putting in place a proper green new infrastructure, having an American air traffic control system that will enable me to fly from Washington to Boston as rapidly as I could 40 years ago. Will there be the political will to do those things once the intellectual understanding comes? Right. I'm not sure. The orthodoxy of inflation fear and deficit fear is a terribly dangerous force. That's why what the IMF's managing director did this week was so important.
Finally, just in a word or two, upside or downside, surprise the upside or downside on the economy overall?
Downside for the next 3 months.
Okay, and there you have it from Larry Summers. That was what Summers says. It's always a delight to have our special Wall Street Week contributor of Harvard, Larry Summers, report on the state of the world and of the economy. Finally, one more thought. Taking aim at the election. As the election of November 3 draws ever nearer, market watchers are reaching deep into their bag of tricks to figure out ways for the markets to predict who will win. We have strategists putting together competing baskets of stocks that would do well under a Biden or a Trump administration. We have currency traders looking at the price of protection against a stronger yen, or the relative cross between the Mexican peso and the Russian ruble. But now there comes what some people think is a nearly sure thing. How are the gun merchants doing? It turns out that gun stocks have pretty much always done well in the lead up to a Democratic victory, probably because gun sales spike when people who want to own guns or want to own more guns get nervous about more gun regulation, which Supreme Court nominee Amy Coney Barrett promises to look at with an open mind.
The way in which I would approach the review of gun regulation is in that same way, to look very carefully at the text, to look carefully at what the original meaning was. So I promised that I would come to that with an open mind.
So what do gun stocks tell us about this election? Well, they were down from August until early September, but since that first presidential debate, they've staged a comeback. There's no substitute for actually counting the votes. But until we can, it may not hurt to keep an eye on which of our fellow citizens are exercising their Second Amendment rights. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.